The pandemic has wiped out the appeal of property investing, according to Martin North, the principal of digital finance analytics. Landlords are under pressure. Interest rates may be low, but capital gains are a long way off and renters are thin on the ground. Martin North says for sale signs are being forced onto hundreds of thousands of properties as prices begin a long, slow slide downwards. Martin North, welcome to the business. How explosive could this rent deferral time bomb be for the property market?
No, I think it's a really big deal. And remember that we've got just under 3 million property investors in Australia. You know, they have 36% of all the mortgage debt outstanding. But my surveys say that a quarter of them are now very much caught in the pincer movement, and the rental freeze and the rental drought is one element. Plus, of course, no capital growth. Interest rates are lower, but that means the negative gearing doesn't work as well. And many are really being squeezed and trying to work out what to do. Frankly, if property investors see no capital growth and no rental streams, the property investment proposition is falling apart.
So with that in mind, is the rental market broken?
Well, it's been broken for quite some time, I think. But of course, what's happened now is that in many markets, there are just no people wanting to move into rented accommodation. Lots of students, for example. I was looking at Redfern today, and their rents have dropped by nearly 10% in the last 3 months. And that's simply because there are less people wanting to rent. And then you've got more people who are in these rental holidays. When you talk to them, they're not clear whether it's a holiday or whether it's just a deferral. So those are there as well. And then the final point, of course, is what happens when all this unwinds. Because essentially, those investors were meant to be paying those mortgages, and will they be able to?
Well, the Reserve Bank has recently said that banks are fairly well capitalised and the people who hold the debt can afford it. It's not too worried about defaults.
Well, I don't think that the Reserve Bank's analysis is actually that deep. I mean, a lot of the data was 3 years old when they actually presented it. And my point is that we're starting to see now what I call structural unemployment. Those are jobs at the top end of town, not just the part-time gig jobs that disappeared first. So a lot of jobs in financial services and consulting. Now, many of those people actually have multiple investment properties and are cross-leveraged one to the other. And we're already seeing in our surveys a very strong sense from those more affluent borrowers that they will have to do something quite radical. They might not default, but they may well decide to sell. And we're certainly seeing very significant sell pressure now in the property investment sector. And a lot of it's coming in at the top end.
So you're expecting to see a whole lot of rental stock being dumped on the market then? When?
Well, it's already starting to happen. So if you look at the spring selling season, which is now beginning to power up, our focus groups are highlighting a number of property investors who are determined now to put their property on the market. Of course, there was one of the CEOs from one of the banks the other day said it's probably a good thing if you're going to sell early, and I think that's right. You know, the old adage, if you're going to panic first. We're going to see a lot of stock coming in onto the market in some areas, not universally. Mostly, I think units. I think the unit sector is really going to take a major bath. Houses perhaps less so. And not all markets behaving the same, but generally more stock, less buyers willing and able to buy that stock because international investors pretty much have gone now. So it's first-time buyers and up-traders. And frankly, first-time buyers are being bribed to come into the market with all those incentive schemes. But if you're buying into a falling market, that might not be very smart. So yes, I think the market's in for a bumpy ride.
I mean, our story highlighted renters that were in a very vulnerable position, but many renters and landlords perhaps are positively geared, perhaps have secure employment and are able to weather this pandemic. I mean, as you point to, it's not a black or white issue.
No, spot on. So we know that there are a number of people who are doing just fine. And around a quarter of property investors are really feeling it. So they figure in our stress metric. So that's 800,000. So it's not everybody. But the point is that it's actually quite concentrated in particular postcodes, in particular types of households. And unfortunately, the property market has been supported for a generation by very positive property investment. It's been one of the major growth engines, and of course the banks lent very hard into that sector.
Well, you said that you think property investing may have had its heyday. How will it look post-pandemic? What types of stock will people be interested in? And you mentioned inner city apartments falling out of favour. How do you see it looking as we emerge out of this recession that we've been induced into?
I think in terms of types of property, units, I think, are the ones, particularly those masses and masses of relatively newly constructed but poorly constructed high-rise units around the place in the urban fringe and further in as well. They're the ones I think going to take the major bath. I see prices potentially falling up to 30 to 40% there, simply because we've got way too much stuff all looking the same, and frankly, all probably on the market at the same time. Houses, less of an issue. I think there's always a lack of supply of really good, high-quality housing close into the centre of cities in most of the major urban centres.
Martin North, we appreciate your time. Thank you.
Good to talk to you.